This is an updated video on section 8.2, which is about taxes. We will talk about federal income taxes and FICA taxes, which come toward the end of the lesson. Definition of federal income taxes: they are a percentage of your taxable income. We will define that shortly, which is based on your earnings in the calendar year, January to December. Here is a brief history timeline of the U.S. income tax. I'm not going to talk about it in this video, but you could pause it and take a look at that. There are some interesting dates. Next, I have a circle graph or a pie chart about how federal income taxes are used. This was from the year 2018. It talks about Social Security, National Defense, Medicare, health, social programs, interest on our national debt, other programs, which might include our national forests, our national parks, our interstate highway system. There are lots of things that our federal taxes are used for. If we go on, let's talk about the mathematics of calculating federal income tax. Calculating your federal income tax starts with your gross income. This is your total income for the year. This includes income from, and you might want to make a list, wages, tips, which you receive in some different jobs, interest or dividends on investments, unemployment compensation, profits from a business, rental income, and even game show winnings, or if you participate in certain games of chance like horse racing, some of that is required to be counted as gross incomes. The next step in calculating your federal income tax is to determine your adjusted gross income. Your adjusted gross income is figured by taking your gross income and subtracting certain allowable amounts called adjustment. These untaxed portions of your gross income include, once again, you may want to pause and make a list, contributions to certain retirement accounts, tax-deferred savings plans, interest paid on student loans, and some self-employment costs. In a traditional tax-deferred retirement plan, you get to deduct the full amount of your contribution from your gross income. It would be in the form of an adjustment. You pay taxes on this retirement money that you're saving later when you draw it out of retirement. So here's a summary statement. Your adjusted gross income is your gross income minus those adjustments. You are entitled to certain deductions, which are subtracted from your adjusted gross income before calculating your taxes. Now, these deductions come in two different forms, and you would have to choose. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. It is just an amount. It is a dollar amount, and I will show that to you. The IRS sets this amount and changes it periodically. Most young people take the standard deduction because their financial situations are relatively simple, and they are not eligible for the numerous deductions associated with owning a home, making charitable contributions, and sometimes medical deductions. All right, these itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. These include interest on your home mortgage. You will get a statement from your mortgage company that will give you this amount. State income taxes, which is not applicable in Texas. Property taxes, yes. Charitable contributions, yes. And medical expenses if they exceed 7.5% of your adjusted gross income. Taxpayers should choose the greater of the standard deduction or the itemized deduction. Here is a little formula. Taxable income, this is the amount you will be taxed on, is calculated by taking your adjusted gross income, that's the one that you've taken your adjustments off of, and subtracting either the standard deduction or the sum of your itemized deductions. Now, the first few homework questions that you're going to encounter are going to ask for three things: your gross income, your adjusted gross income, and the income that will be taxable. It says, base the taxable income on the greater of the standard deduction or the itemized. Because remember, the taxable income is your adjusted gross income, and you subtract off either the standard or the itemized deductions. You will want to have a calculator handy to do any of these questions. Any standard 4-function calculator will work, or you can use the TI-84 or the phone app that you've gotten for this course. There is a story right here. It says, a taxpayer earns wages of $48,300 and receives $470 in interest from a savings account. Now we can pause right there. Those are two forms of income. Your gross income is the sum of those. There's the $48,300 plus the income that you got from interest on savings. If you add those together using your calculator, you will have a gross income of $48,770. And you will put that in your first answer box. You do not put the $sign because it has it already. Now, going on, it says these were your different forms of income. Now it says, and you contributed $7,100 to tax-deferred retirement plan. That is an adjustment. You don't have to pay taxes on that now, but you will when you use it in retirement. So the adjusted gross income is your gross income from part one, bring it down, subtract the adjustment of $7,100 to get your adjusted gross income, which is now $41,670. Now the taxable income, let's go back and finish reading this. He had itemized deductions totaling, now they didn't tell us where they came from in this question. They're just saying if he added up all of his itemized deductions, it would be $7,310, which is less than the standard deduction of $12,550 for his filing status. Now, it changes based on whether you are single or married or something called head of household. But this person was single. So their amount was $12,550. We will choose the standard deduction over the itemized direct deduction because it is greater, and we want to subtract as much as we can. Take the answer from the second part, which was your adjusted gross income, subtract off the standard deduction, and you end up with $29,120. It goes in this box. That is your taxable income, significantly less than your gross income. This is what the federal government will use to determine how much taxes you pay, and we will look at that, I think, on about question number 4. Question number 2 is very, very similar. We're going to find gross income, adjusted gross income, taxable income, and we will base our deduction on whether we use the standard or the itemized. All right, a taxpayer earns wages of $185,500 and received $1,500 in interest from a savings account and contributed $19,200 to a tax-deferred retirement plan. She had itemized deductions. We don't know where they're coming from yet, but someone added up her deductions, and it's $23,940, which is more than the standard deduction. We saw it in question 1, $12,550 for her filing status. All right, her gross income. We add her wages and the interest she earned from a savings account to get a total of $187,000. Remember, you can pause this video anytime you want if you are writing down notes. Her adjusted gross income, which is sometimes called the AGI, is her gross income. Take the answer to the first part. And she had an adjustment in tax-deferred retirement plan of $19,200. Subtract that, and her AGI is $167,800. Now her taxable income, it is the AGI minus her deductions. Was it better to choose her itemized deduction total or the standard deduction? The itemized was significantly larger, so I chose that. I subtract to get $143,860. That is the income that will be used to determine her taxes. Question number 3. We will have a little bit more to do on this one. We're still looking for gross income, AGI, and taxable income, but this time we are going to have to work a little harder to get her total, or his total, for itemized deductions so that we can compare. All right, starting at the beginning. He earns $44,750 in wages. He received $180 in interest from a savings account. By the way, you get a notice either online or in a letter from any saving institutions where you have an account. So you should get those at the end of the year or in January. And contributed $2,800 in tax-deferred retirement plan. He is entitled to a standard deduction, $12,550, we've seen that. And here we go. The interest on his home mortgage was $2,900 or $2,900. He contributed $600 to charity, and he did not live in Texas, and he paid $1,350 in state taxes. We will have to, in a moment, calculate his itemized taxes. Now, let me just pause for a second. In Texas, we do not have state income tax, but we do have sales tax. And there is a way to either itemize your sales tax, where you have to keep every receipt you ever got, or you can take a percent of your income and count that as your sales tax. Okay, let's get back to this question. Gross income, $44,750 in wages, $180 in interest from a savings account, for a total gross income $44,930. Now, adjusted gross income, AGI. This is where we subtract off adjustments, which for us are going to usually take the form of tax-deferred retirement plans. So here is the gross income. He contributed $2,800 to a tax-deferred retirement plan, meaning his now adjusted gross income is $42,130. His taxable income. Taxable income is your AGI minus either the standard deduction or the itemized. Standard deduction is published in the law. It is $12,550. His itemized was mortgage interest, charity, and state taxes. I added up all of those appropriate itemized options, and I got $4,850. In layman's terms, we would say he should not itemize, because his itemized deductions were a whole lot smaller than the standard deduction. So I will take the adjusted gross income, subtract off the standard deduction, and this is his taxable income. In a few minutes, we will get to a question where we use the tax tables to determine, so how much does he pay? Number 4, similar to number 3, it asks the same 3 questions. It wants to know gross income, adjusted gross income, and taxable income. And we will have to think about what kind of deduction do we take, itemized or standard. I went ahead and made a note of the standard deduction for this single person. All right, the gross income. He was a single or a taxpayer that earned $178,700 in wages and $15,200 in taxable income from investments. Okay, those are 2 forms of income. His gross income is adding those 2 together. His gross income is $193,900. His adjusted gross income, let me keep on reading. He contributed $17,000 to a tax-deferred retirement plan. He does not have to pay taxes on that money right now. It's in a protected savings. Sometimes you will hear things like 401k, IRAs, and so on. So we subtract that adjustment. So his AGI is $176,900. When it comes time to calculate the taxable income, it is the AGI minus either the itemized deductions or the standard. The standard was $12,550. But let's see. He had interest on his home mortgage of $9,875. I wrote it down. He contributed to a charity $23,000, and you had better keep the receipt if you use that as a deduction. He paid $5,275 in some form of state taxes. I put those three items down. I added them up. I got $38,150. Now you compare. Do you want to deduct $12,550 or $38,150? We want the largest deduction possible. So we take the AGI, subtract, and I kind of circled, you can't see the one very well, but the taxable income is $138,750. Before we move on to the next question, I want to show you this chart that talks about marginal, which are variable, tax rates. You pay different percentage of your income based on how large your income is and your filing status. If you are unmarried, divorced, or legally separated, I will show you how to choose which category or which categories, because sometimes it's multiple categories. You will pay the appropriate percent for each part of your income. And here's your standard deduction. If you're married and your partner files a separate return, it is not different until you get to here. And the standard deduction is the same. If you're married filing jointly, it is very different. These ranges are much greater, and your standard deduction goes up to $25,000. If you are unmarried and paying more than half the cost of supporting a child or a parent, you can be considered head of household, and these numbers are different, and your standard deduction is different. Here is a summary. This is something that might be useful to print. All right. Calculating your federal income tax. You start with your gross income. It lists what kinds of things go in there. You subtract off your adjustments. It lists what kinds of things go in there. And you subtract to get your adjusted gross income. Then to get your taxable income, you take your adjusted gross income and subtract deductions, either itemized or standard. That's all we've done so far. Now we're going to, in the next few questions, determine your income tax, what you would owe. The tax computation. Use the taxable income and the tax rates for your filing status to determine this amount. I will take time to explain this computation. You subtract off tax credits. Now, tax credits, these are subtracted off of the actual taxes owed to reduce your tax liability. Not before. Deductions, adjustments, everything comes off before you use the table. Credits come after. These usually take the form of things like adopting a child, buying an electric vehicle. I don't know now if it used to be that daycare was in this. I don't know if it is now. Okay. All right. Question number 5 has us focus on using the marginal tax rate, this table. Honestly, most people use software which has this built into it, so you don't have to do this. But this is excellent work to get you to understand what's going on inside that software that you're using. Okay, This is from 2021. By the time our textbook gets published, this is going to be slightly out of date, but the process is the same for the 2023 taxes that you could begin to file in January of 2024. All right, it says to use this table, it's given, to compute the tax owed by a person that is single and has a taxable income. So somebody's already done the gross income, the AGI, and the taxable income. So we have this number. How do we use this chart? They tell us the person is single. That means that I'm going to use only this column. All right. I will take $51,000 and I will go look at these ranges. This is $1 up to $99.50, $99.51 up to $41,525, $40,525, $40,526 up to $86,375. Now our 51,000 fits in this range. So I have marked out the top end of this and put hours. We're not going to get taxed on more money than we actually had. So to figure it out, what it's saying is the dollars in this range, not all the dollars, but the dollars in this range will be taxed at 22%. The dollars in this range will be taxed at 12%. The dollars in this up to $9,950 will be taxed at 10%. This is what it looks like. You notice that I've put red check marks on the largest number in each category. In order, we can look at the first one. Well, did you make more than this? Well, yes, we have taxable income of $51,000. So you're going to pay 10% of all of this part. So 10% is 0.10 in decimal form of $99.50. But you're also going to pay 12% of the dollars in this category. But what you subtract is the top end minus the top of the previous one, not the one with the one, top of the previous one. So it is $40,525, subtract the top of the previous one, 9,950. You're going to pay 12% on those dollars, the difference of those. Finally, in the last or the highest category, you will take your top, which was 51,000, and subtract the top of the previous category. So it is 51,000 minus, there it is, 40,525. You're going to pay 22% on that. You will put that entire line in your calculator. At least it will be quicker if you do. All right, here is the calculation. If you're using the TI-84, it is just this exact amount. If you don't want to try to put it all in there at once, you can do this difference, write it down, do this difference, write it down, and then have 0.10 times this, 0.12 times that difference, 0.22 times that difference. There needs to be added them all up. And this person owes $6,968.50 in taxes. Let's look at number 6. This is, I believe, Hang on just 1 minute. All right, I noticed a little mistake, but luckily it did not affect any of the computation. This individual is married filing separately, and even though I addressed this column with this red arrow, I should not have. It is this column. I am so lucky that up to this point, the columns are the same. In fact, the next row is also. So the fact that I went over here, although it was a mistake, it did not impact this particular question. All right, this person has a taxable income of $153,000. We should be in this column. So for the first $9,950, they're going to pay at a 10% tax rate, 0.10 times 9950. In the next category, you will take $40,522. Oh, I apologize. Let me go ahead on something. Your taxable income was $153,000. I should write it right here. I wrote it over here accidentally, but it should be written over here. So I'm going to take in every category up to that, I'm going to take the larger number and subtract the previous larger number. So it is 40,525, subtract 9950, and that's at 12%. Then we exceed everything in this category. So you will take 86,375 and subtract 40,525. Here it is. And that is in the 22% category. Finally, in the last one, this would be 153,000, and you will subtract the 86,375, there it is, and you will pay 24% of that. So wherever your taxable income falls, you will take all of this and pay it 10%. You will take the 40,525 minus this, pay it 12, 86,375 minus 40,525, pay it the 22%, and then your number minus this to pay in this problem at the 24%. If you do that calculation, that one, and that one, you find the sum of all those, you have a taxable bill of $30,741. It's rather large. In problems 7 and 8, we're going to start at the very top and calculate everything with one final answer, income tax owed. A lot of work for one answer. Here we go. In order to do all of this, I start with my gross income. I have an adjustment, probably tax deferred savings, and I get to take 82,000 minus 9,000 to get 73,000. That is my adjusted gross income. Next, I'm going to take the adjusted gross income and I'm going to subtract either standard deduction, there it is. Oh, that should be, I'm so sorry. That should be 12,550. I ended up not using it, so it didn't hurt. Itemized deductions. We have mortgage interest. There it is. We have property taxes. There it is. We have charitable contributions. There it is. We add those together to get the itemized deduction. So, do I want to deduct $19,800 or $12,550. It's right down here. This is a single person. And I choose the itemized because it was more. My taxable income, now this is what I did in the first few questions, is my AGI minus, in this case, itemized deductions for $53,200. That's my taxable income. Look at the chart. 53,200 would fall in this category. So I wrote it right here. I will pay 10% on this amount. Here it is. I will pay 12% on 40,525 minus the 9950. Remember, it's the big number minus the previous big number at this percent. Here it is. 12%. Then the largest amount I have here is 53,200. I subtract the previous upper limit, and so it's 53,200 minus 40,525, and I pay that at 22%. So you're taking your money and you're saying, okay, everything up to $99.50 I put in a pile and I'm going to pay 10%. Then I'm going to take everything up to this from the $99.50 and pay it 12. Everything from the $40,525 up to this. So you're looking at different pieces of your money. Add them all together, the 10% of this, the 12% of this, the 22% of this, to get $7,452.50. Okay. The last question, this one, the person is married, filing jointly. I'm in this column. Okay, so we start at the beginning. Gross income minus adjustments give me the AGI. 157,000 minus 21,400. Here is my AGI. For married filing jointly, the standard deduction is 25,100. So that's my standard. Itemized, let's see, 4,710 in state taxes, 10,700 in interest on your mortgage, 5,300 on your property taxes, and finally 14,500 in charity. I add all of those together, and your itemized deduction would be 35,210, which is greater than the standard, even though they're married. So I will take my AGI right up here, subtract off, in this case, the itemized deduction to get a taxable income of $100,390. Now I look in there, and $100,390 falls in this category. So I will pay 10% of 19,900. There it is. 10%, 19,900. Go to the next upper limit, the bigger number, and take the 81,050, subtract 19,900, here it is, and you will pay 12% of that. Then finally, you will go to your 100,000, 390, and subtract the 81,050, here it is, and you will pay that at 22%. And this is what you get. That's the taxes you owe, but this person has a tax credit. And so we will subtract the credit straight from the income tax owed. And in this one, and I'm sorry I cut off the cents, you will end up with $5,982, and I believe it was 80 cents in your taxes owed. So watch out if you notice a tax credit. All right, I'm going to stop now, and the next video will be about FICA taxes. Changed my mind, decided just to make this a nice long video. FICA taxes, it's part of the Social Security Old Age Survivors Disability Insurance Program. Specifically, FICA stands for Federal Insurance Contributions Act. It was created in 1935, and it was kind of a way to force people to save for their retirement, and the government helped with that. Medicare was added to it in 1966, and they are under one umbrella now. So it talks about the FICA tax was 7.65, which broke into Social Security and Medicare, but in 2023, they remained the same, but the taxable minimum raised, so on and so forth. So single filers who make over $200,000 and joint filers who make over $250,000 are also required to pay a little extra Medicare tax, which was part of the Affordable Care Act, sometimes called the Obama Act or Obama Health Care. All right, let's go down here. Here is the chart. It is much smaller, and you are not affected by whether you are filing single, joint, or whatever. It is employees versus employers versus self-employed. We are going to stick in this column. It says use the 21 FICA tax rates, and I'll go up here and use those. Well, they're written down here. I don't have to. They're not self-employed, and they earned $122,000. That is gross. They don't care about AGI. They don't care about taxable income. It's your gross. So you pay 7.65% on the first $142,800 of income. Well, you didn't make that much. You made $122,000. So all you're going to do is change the percent to a decimal, multiply it by that gross, and you will pay $9,333 in FICA taxes. Now, you never see this money. This money is taken out before you get your paycheck. So you can look and see it has been taken out. They certainly don't take all of this out at once. They take it out month by month to accumulate to this. All right, this last one, this person makes a little more money. They're not self-employed, but they are an employee, and they earned $165,000. Now, $165,000 is greater than this. So we have to go down here, and it says to pay 1.45% on the rest of it, of everything in excess or greater than $142,800. So we've got two pieces. 0.0765 times the first $142,800 plus sign, change this to a decimal, 0.0145 times the rest, which is 165, that was your gross, minus what you've already paid on this one, 142 $8,800, you pay a little piece, a little percentage on that, and add them for your total FICA taxes. So I know it's a long video, but I hope it's helpful. You might want to watch a little video and pause and then do the appropriate homework questions. I hope that this is helpful for working on taxes.